Hi, and welcome back to Tim Bigham's Options and Volatility newsletter. We'll be taking a look today at our most recent iron condor trade in Microsoft, where a big spike in implied volatility, along with an expectation of continued consolidation, set up ideally for an iron condor trade that profits from nothing happening. So let's jump in and take a look. First of all, here's the trade recommendation came out on September the 26th, so on Tuesday, right? So you can see the rationale behind it. It's trading Microsoft right around the 315 kind of major support level. IV has popped lately, now at the 35th percentile, so we absolutely like to sell a higher level of implied volatility when at all possible and when at all rational, right? And this certainly fits the bill on both of those. Valuations are still at an extreme, in my opinion, on Microsoft, but they have tempered dramatically. So we saw that big rip here, the big pullback. Now it's starting to kind of bleed out sideways, which fits, again, ideally selling both sides of the market here. For those unfamiliar with an iron condor, it's simultaneously selling an out-of-the-money call spread and an out-of-the-money put spread on the same stock, the same expiration date. And in our case, we use the same strikes as far as the spread width here. So 5-point wide on the call side, 5-point wide on the put side, just to make the risk more kind of balanced and not have a unbalanced sort of iron condor here. So our trade was actually selling the October 20th, the traditional monthly 335 calls, hedging by buying the 340 calls, and then simultaneously selling the 300 puts for the same expiration, October monthly, the 20th, and then hedging by buying the 295 puts of the same expiration. So selling a 5-point wide call spread, 5-point wide put spread, right, which gives us a balanced risk sort of approach. You can see also our return on risk is roughly about 50%. How do we figure that out, right? Well, it's simply the net credit we receive, right? So we're looking to sell it to bring in $1.65 net credit, which we were able to do, right? Our max risk on the trade, right? Either the put spread or the call spread is going to be in trouble, right? Not both at the same time. So our max risk on the trade is 5 points. So our total overall risk, right? Because we brought in $1.65 at inception, we have $5 potential risk, but our max net risk is $3.35 on the trade, which is simply the strike differential minus the net premium received. And so it's $1.65 on 335 of risk, or roughly about 50%, just under that 49 and a quarter potential return on risk. So we like that as well, and have that nice 20-point upside cushion. Microsoft was right around 315 at the time, so the 335 calls were 20 points above where Microsoft was trading, and the 300 puts that we sold, right, with Microsoft at 315 were 15 points below where Microsoft was trading. So we like the fact that we have decent cushion on either side, and it's balanced as well. We're not, overly bullish or bearish here. In fact, you'll see in a second, we're about as neutral, about as delta neutral as you can be. So let's jump in and take a look at the trade. So here's the day of the trade. As you can see, Microsoft closed the day at 312.14. We did it basically, right after the opening. You can see the stock did move higher and lower on the day. 310 was the low. Let's call it 316 roughly the high on this. It did pull back and close kind of in the middle of that trading range. So that iron condor selling the call spread and put spread simultaneously, as you can see here, closed at $1.64, but everyone I know received at least $1.65 net credit on the trade, as we kind of recommended on the initial trade. Now taking a look at the IV on the trade, right, we were able to sell the puts at about a 28.48 IV, right, and these are just the puts we're selling. We're not going to look at the wings we buy for our hedging mechanism, because simply that differential will probably remain constant here. So I don't see the skew changing too much in a short time frame, especially on Microsoft, right? So basically the puts that we hedge with are going to be always about a point higher from an IV perspective, and then on the call side We were able to sell at 24 roughly IV, and then hedge with slightly lower than that, 23.83. And same thing on the call side. Usually you see the further out of the money calls traded at a slightly lower IV. So our IV on the call and the put we sold combined here a little over 26, 26 and a quarter, which certainly we'll see in a second was about the highest we have seen in a very long time in Microsoft. Our net delta on the trade, right, is 2. So we are 2 deltas net long, which is about as neutral as you can be, right? That simply means that 2 deltas is equivalent to about 2 shares of Microsoft stock. So how do we figure that out, right? Take the delta on the put that we sold negative 20 delta, but sold means a positive 20 delta, bought a 20 negative delta. So selling the put spread would put you about 7 deltas net long. Makes sense, right? Selling out of the money put spread, slightly bullish, 7 deltas net long here. Call side, the exact opposite of that. We would be selling a 15 delta on that 335 call we sold, hedging with the 10 delta. So we'd be about 5 deltas net short. Again, makes a lot of sense. Selling out of the money call spread, right? Slightly bearish. Combined effect, 7 deltas net long, 5 deltas net short. We would be 2 deltas net long, or again, about as neutral as you can be. We were positive theta, of course, on this trade. And again, we always like to take a look at theta. Time premium decay works for us, not against us, which is another advantage of selling iron condors here, right? So we would be able to sell a negative 14 theta, right? Buy, though, a negative 13, so it would be 1 theta, 0.01 net long theta. So in other words, we should expect to make about a penny a day, at least for the short term, on this out of the money put spread. On the call side, right, you can take a look at the theta, 10 and negative 7. So we would be basically 3 long theta on that. So our combined effect on theta, right, we expect to make 3 cents a day on the call side, 1 on the put side. We expect to make about 4 cents a day in theta, simply because of time premium decay. So again, the price on our iron condor about $1.65 on $1.64 is where it closed at, but you certainly would have been able to get that $1.65 a penny more. Our return on risk 49.25%, as we found out back here, where we simply took our net credit divided by our net risk. Then fast forward to Friday's close, you can see implied volatility is now under 24, 23.68. Remember, when we initiated the trade, it was well over 26 combined. However, things have calmed down, right, dramatically. So we see now the implied volatility drop fairly, appreciably, certainly lower IV in Microsoft, right? This kind of move is a kind of a big move in Microsoft. Our net delta virtually flat now. We were virtually flat, 2 deltas net long earlier. Now we are officially flat here, right? We can take a look at the delta. Negative 19, negative 14 means we'd be 5 deltas net long, selling that 300, 295 put spread, right? And on the call side, right, same thing here. Negative, selling a 14, buying a 9, minus 5 deltas on the call side. So it would be 5 deltas net short. On the call spread side, combined effect, we are delta neutral officially. Our net theta remains constant, right, pretty much here. About 2 pennies net delta on the put spread, right, simply because we're getting a little closer to expiration, right? And then on the call side, we're looking at 3 deltas net long, 9 and 6 here on that. So our combined theta has popped up just a little bit to about a nickel a day. However, now the price of that iron condor has dropped to $1.15. Why? Because we saw this big drop in implied volatility. So those puts, which are midpoint here, priced about 214, you can see earlier, right, we're trading somewhere, around the 388 level. And we did see the stock rally, so you expect a drop in the put price, but not that dramatic. The calls, which were trading about $1.42, right, now are trading about $1.20 or so. So both the calls and the puts have gone down in price, which is certainly a benefit here. Now our hedge, right, have both gone down in price, but not nearly as much, which is why, selling high implied volatility makes sense on these iron condors. You get that big edge. So our iron condor now priced at $1.15. We ought to sell it on Tuesday, right? 3 days earlier at $1.65. So I've already picked up 50 cents or so on that. Now taking a look at that IV pop that we talked about, right? You can see here is the puts and here's the calls. The puts are in the lighter green, the calls in the darker green. But you can see both because of put-call parity move in unison. But you see this huge lift in implied volatility, which we talked about, right? IV has popped lately on our original recommendation, right? And then you see it soften. So this is where we put the trade on, and it's starting to soften. So we'll be absolutely looking to take some, if not all of the trade off soon, and realize a nice gain on the trade. So in essence, sell the rip, buy the dip, as we do in our straightforward sort of vol capture trade. Valuation, we talked about that too, was at extremes, but has softened somewhat, right? So looking back at the end of July, we saw it on a price to sales ratio. I prefer that over PE and other valuation metrics. It's a much straightforward one. When you look at PE, certainly stock buybacks and accounting gimmicks can really, cloud that one. But you can see it move from well over 12 to now, right, trading at right around 11.08 on Friday. So the valuation has softened. So we're getting more into a normal sort of range here for Microsoft. So we saw this huge kind of AI explosion. That's pulled back here. So I think going forward, you'll see Microsoft and the rest of the market kind of maybe trade out sideways here, at least for the time being. So taking a look at the trade, our net gain on the trade, as we talked about, able to sell it at $1.65, buy it at $1.15, at least on Friday's close. So you'd be up about 50 cents on the trade. Now, some of that, right, is delta and theta gain. In other words, time premium decay and being arguably delta long, although so small it really doesn't mean a lot here, but we'll still go through it anyway. So our expected theta gain, right? So we held it for 3 days, right? Our smooth theta, right? We started off at about 4 positive theta, ended up at 5 positive theta. So we're roughly 4.5 cents a day we make on time premium decay times those 3 days. We'd expect that spread would have head our way by about 13.5 cents. Excuse me. So certainly not inconsequential, and that's another big benefit of selling, premium generally, but certainly defined risk premium. You usually almost always have decent positive theta time working for you, and especially when implied volatility lifts, the theta actually gets a little bit greater as well, which makes sense because option prices become higher and they have to either expire at parity or worthless. Our expected delta gain, right, we would have been slightly delta long, right, about 1.5 net deltas, right? We started off 2 deltas net long over the course of those 3 days, right? If you smooth it, would have been about 1.5 deltas net long. The stock did move up 3.5 points or so roughly. So you'd expect to make a little over a nickel on the trade just from a delta perspective. So the combined effect, roughly about 19 cents net gain from time premium, let's call it, 14 cents, a nickel from delta. But we actually gained, as we said, 50 cents on the trade. So that vol capture was a very nice 31 cents or so on the trade. Why? Because of that big IV reversion of 2.5 vol points, which for Microsoft is pretty large here. And again, it's selling the rip and then looking to buy that dip. We're not looking for it to go back to where it was for a long period of time here because IV tends to get sticky, but certainly somewhere around here, we're getting close to the point where we'd be looking to take that trade off. So again, we're able to sell a 26.25 smooth IV, right? 28.5 roughly on the puts, 24 on the calls. And then on Friday, just 26 and change on the puts and 21 on the calls. So both came down decently in price. And to compare it to a very similar iron condor when Microsoft was at basically the same price back in May here, right? So we're looking at a 24-day initially Iron Condor, which was the days to October expiration on Tuesday when the trade was done. So when we take a look right at the same trade from May the 16th, we can see the stock 311.74, right? The day that we did the trade 312.14. So almost identical, right? 40-cent differential, certainly not consequential. The IV, however, back then, right, and this is from May 16th, right, 24 days to expiration, right, same amount of days to expiration as we're looking at there, but the implied volatility between the puts and calls was only 20.4. Remember, we're selling a 26.25, right, so almost 6 vol points higher, or if you want to put it in percentage, almost 30% higher, right? What does that do? That explodes that iron condor. So that same iron condor back then, right, was trading under $1.10 at 108.5, right? So our return on risk, if we would have done it back then, still would have been okay, 27, almost 28%, but certainly a far cry from our, almost 50% return on risk by doing the same trade, same time to expiration, same stock price. And I will almost argue even lower risk because we saw the big rip and we've seen the big dip. So usually things tend to bleed out here. So hopefully that, gives you an idea how we go about identifying trades, how we go about structuring trades, and then more importantly, how we go about analyzing trades to make sure we have that bona fide edge, and certainly in this case, a very nice edge indeed, where a lot of the profit has been realized and we'll be looking to take part, if not all of the trade-off over the next several trading days. So until next time, as always,